Hello, this is Joe Pryor with the virtualrealestateteam.com in Oklahoma City, a part of Redbud Realty and Associates. And this is part 6 in our Investing in Real Estate in Oklahoma City series. And we've gone through a lot, but what we need to do is talk about leverage and financing today. Now, right now, over 50% of all properties bought in the United States as investment properties are being cash purchases. Now, part of the reason for that is some of the prices have gone so low in some of these markets that it's almost like using your Visa to buy a home. That's how devastated some of these condo units and things have been done. But most times, people are buying homes with leverage. Now, essentially what leverage means is using other people's money, right? So in other words, we have a certain percentage we put out cash, and then we're using the bank's money to make money. Now, two things about real estate. Leverage is really good on paper. It is something where I can show an increase in your return on investment because the more borrowed money that you use, usually the higher return on investment it's going to be. It's return on your actual cash output. So that would stand to reason. Now, of course, this always has to be balanced out with risk. And the risk factor is if I buy something at zero down, like in 2005, then there's a great risk that I may be underwater on my mortgage. And that's one of the reasons for the changes now. So if you're an early buyer in investment properties or just getting into it, you're going to be getting a conventional loan that is typically Fannie Mae backed or Fannie Mae guidelines. Now, what that means at this time is that if you're buying your first investment property, it's going to be 20% down payment. That is just what it's going to be. Rates are good right now, but you're going to have to come out if it's like that $100,000 house we typically use. That's going to be $20,000. The good news is you won't have mortgage insurance. So you've got to be prepared to do that. Now, Fannie Mae has two limits or two numbers that are very important, 4 and 10. The 4 is the total of mortgages that you have. So for instance, if you buy a couple investment properties, you have a primary home that you live in that has a mortgage, and maybe you have a lake home that has a mortgage, that's a total of 4 mortgages, regardless of the kind that they are. Once you reach that point and you get to the 5th mortgage, two things happen. Fannie Mae makes you put 25% down, so you have a little less leverage. And then second of all, the reserve factor, the money and principal, interest, taxes, insurance that you need to put back is greater. Now, it depends on the kind of retirement account that you have. So sometimes there's a lot of cash involved because they up the ante on all the properties that you have. Or if you have a 401k or something where that sufficient amount of money is there, you don't have to do that, but you have to show more reserves without question. Then Fannie has a limit of 10 properties total. And so in other words, once you get to 10 properties, you're done. That's the total amount of mortgages that you can have. So in that particular case, then what do you do? And I do have investors that have 10 or more properties. Well, then what we do is we go to special financing. Now, special financing can be a couple of things. Number one, it could be an owner carry. Now, the only reason I would recommend owner carry if somebody owns a property outright. I do not recommend you buy property and do a wrap or a contract for deed. There's an incredible amount of risk involved. You can be putting out a lot of money and the house can go into foreclosure and you don't even really know it and can't prevent it. But if somebody owns it free and clear, they have the right to be their own mortgage company. So that is one way that you can do something to get another property. Doesn't happen very often. So I'm going to tell you two others that are very prominent in the United States today because of our foreclosure market. Now, we don't have as many of these here in Oklahoma, but we have a lot of them in other parts of the country. One of which is VA, veterans loans, which by the way have a fairly low rate of foreclosure, but you know, again, there's a lot of veteran loans out there. And so what the VA does is when they have to take these properties back, they actually finance these for you, back to you. And so whether you're a veteran or not and you're an investor, you can buy a VA, what's called Vindy financing property at 5% down. And that is many as you want. You can do 5% down. There's higher closing cost, but you can ask typically for up to 3% closing cost, and then you may be out 8 to 10% total once you get your escrows and things in there, but still a whole lot less than 25% and the ability to buy. And the other good thing about the VAs is that also you have no mortgage insurance whatsoever. You have really low prime interest rates. And so that can be very, very good. So the cash flow on these properties can be tremendous if you buy right. Like anything else, you got to buy it right. So you can do that, and you have to qualify through Bank of America. If you want to do this, let me know. You can qualify for a Bank of America on this anywhere in the country. Now, there's a second time of foreclosure, which is called, if any may, it's called a home path program. And this is where typically an investor may be able to buy property at 10% down and possibly even put some money into having the house fixed up. There's some special financing involved in that, and however, that is not going to be available, again, to my understanding, and I may be wrong about that, and I'll get back in the next video on you, in terms of having a lot of mortgages on that. But that's another way of increasing your leverage. And again, when you're buying a property and you're buying something at $100,000 and you're paying cash, obviously you don't really have much of a downside risk on losing value because you know you can get some cash out of it one way or the other. The other idea is to buy 3 properties instead of 1, triple your cash flow, use someone else's money in order to buy the property, and have greater income from your rental properties. So if you're in the market, we'll get you into these different kind of properties no matter how many you have. If you want to do a VA off the bat, then we'll do that for you. You don't have to do that. There can be some tremendous buys out there that are not. And so what we want to do is match up the right property for you, make sure it's a good value, and make sure the financing is correct and meets your needs. This is Joe Pryor with the virtualrealestateteam.com in Oklahoma City, where we deliver traditional real estate values at the speed of technology.